investors looking to?
Imagine waking up tomorrow and discovering that nearly $41 trillion, almost double the size of the US economy, had vanished from the global markets overnight. It sounds like the plot of a financial thriller, but it's not fiction. It's a real warning from Bank of America, and it's sending shockwaves through Wall Street. Now, investors everywhere are asking, are we standing at the edge of the biggest financial collapse in modern history? Today, we're diving deep into what this $41 trillion threat really means, where it's coming from, how it could impact your wallet, and why this moment could change everything. Over the past few weeks, financial markets have been on edge. Global investment flows are starting to shift. But now, Bank of America's latest report has turned up the heat. According to their analysis, up to $41 trillion in global wealth is at risk of rapid devaluation, driven by a perfect storm of economic and geopolitical pressures converging faster than anyone predicted. At the core of this red alert is a massive shift in capital flows. Money is moving out of U.S. assets and heading into emerging markets, gold, and alternative safe havens. For decades, investors have treated the U.S. dollar and treasury bonds as the ultimate safe bets. But that confidence is breaking down. With skyrocketing U.S. debt, rising interest rates, and intensifying global political instability, big money players are getting nervous. And when the hedge funds and sovereign wealth funds start moving their cash, the ripple effects can be devastating. Bank of America warns that a rapid sell-off in U.S. bonds, stocks, or currency could spark a chain reaction through the global financial system, hitting stock markets, pension funds, and even the banks. This isn't just a Wall Street issue. It could reach into every corner of daily life. Retirement savings could shrink, mortgage rates could spike, and the value of the dollar in your wallet, it could plummet. Adding fuel to the fire is the growing trend of de-dollarization. More and more countries are now conducting trade outside the US dollar system, and that's putting even more pressure on America's financial dominance. If foreign nations start pulling back on their US debt holdings as a group, the market could experience a liquidity crisis unlike anything we've seen since 2008, only on a much larger scale. While Bank of America stops short of calling a full-blown collapse inevitable, their message is crystal clear. The global economy is now standing on a razor's edge. If investors start to panic, that $41 trillion at-risk figure could go from a worst-case scenario to a harsh reality in a matter of weeks, or even days. And this isn't just some abstract number in a spreadsheet. That $41 trillion is tied directly to specific vulnerabilities in the global economy, pressure points that could unravel much faster than anyone expects. One of the biggest fault lines is U.S. government debt. Washington has been borrowing at record levels, with federal debt now soaring past $35 trillion, more than the entire U.S. economy produces in a year. For decades, investors around the world were comfortable lending to the U.S. government because the dollar was seen as the safest asset on earth. But that trust is eroding. With the Federal Reserve keeping interest rates high to fight inflation, the cost of servicing that debt is exploding. And if major holders of U.S. bonds, like China, Japan, or sovereign wealth funds in the Middle East, start to pull out, bond prices could collapse. That would push interest rates even higher and send shockwaves through financial markets worldwide. Then there's the accelerating shift away from the U.S. dollar. Countries in the BRICS alliance, especially China, Russia, and now Saudi Arabia, are increasingly doing business in local currencies or alternative systems like China's digital yuan. Every deal that bypasses the dollar chips away at its global influence. If this trend speeds up, demand for U.S. assets could collapse, leaving trillions in bonds and securities vulnerable to a sudden sell-off. Geopolitical tensions are making things worse. From trade wars with China and sanctions on Russia to growing unrest in the Middle East, global supply chains and energy markets are under constant stress. Investors are nervous, and nervous money doesn't stick around. Many are fleeing to gold, commodities, or even crypto instead of holding U.S. stocks and bonds. And then there's the shadow banking sector, a hidden network of hedge funds, private equity firms, and non-bank lenders managing trillions of dollars outside traditional regulatory systems. If one big player runs into a liquidity crisis, it could trigger a domino effect similar to what we saw with Lehman Brothers in 2008. But this time, the exposure is global, not just limited to the U.S. So no, this isn't a doomsday prediction, but it is a very real warning. Bank of America is making it clear. The system is fragile, The stakes are enormous, and if confidence breaks, the fallout could be historic. That $41 trillion figure Bank of America flagged? It's not just theoretical. It represents real assets that could lose value almost instantly if confidence collapses. All it takes is one spark, one market shock, to turn that number from a distant possibility into a harsh reality. And the big question on everyone's mind is, what will cause the first domino to fall? One possible trigger lies in the U.S. bond market. Trillions of dollars are tied